basically, always, if this is your first time with us, normally what I'll try to do is spend some time talking about marketing plans, and then some of the decisions that we need to be thinking about. And then Dan will kind of follow up and kind of answer all the questions, but really, more importantly, share his insights as to where these markets are going to go. Because as we develop a plan, and then definitely as we're trying to make those in-season, pre-harvest, post-harvest type decisions, outlook is very, very important too, as we try to fine tune those plans. And so, what is a marketing plan? Well, it's a proactive strategy to price your crops before, at, and or after harvest that considers your financial goals, cash flow, storage, crop insurance, labor, anticipated production, appetite for risk, and again, very importantly, your price outlook. Dan and I would suggest typically that, hey, pre-harvest plans. So how I want to price this corn that I don't even have planted yet, we ought to get that done by January. So now is a great time, and we'll be spending some time talking about 2024 December, or our corn marketing plans for 2024. But also we're implementing our 2023 plans. And so we'll spend some time on that probably first. And then throughout the year, we try to implement these plans. Now, what I've got here is just a chart, because I'm kind of shifting over now to the post-harvest here. And where are we at with soybeans? Typically, we'll have about 51% of a crop that we put into storage, whether it be commercial or whether it is on farm. And then we're trying to sell that afterwards. What I've got here is just a quick analysis, but it looks at the last 15 years of Kansas soybean prices, right? So on November, the average November price, according to NASS, this is where these numbers are coming from, it's been $10.42. And then so I just kind of charted that out there in those blue squares. Those are the average prices historically. Now, the red line there with the dots is commercial storage high interest. And in my definition for that, I'm using 7%. And so I took that 1042, added 7% interest, and I'm also using about 6.5 cents commercial storage. Okay. But not everybody uses commercial storage. And so I've got a few other ones in here. I've got on-farm low interest. I got on-farm high interest. I've got commercial low, and I've got commercial high interest. And again, on the interest side, I'm just looking at 7% interest versus, on your operating notes versus say 3.5, which might be more of an opportunity cost. So that's the difference between high and low. And then again, just kind of run through there. On my on-farm storage, I'm making the assumption that we've got a 1% shrink based on that November price. And then a 5-cent in and out charge. Just that it's using utilities, it's using labor. We can agree, disagree, but those are the things I'm using. And basically, so when we ask that question, does storage pay? Soybeans, on average, at least the last 15 years, and according to what I'm looking at, it has paid fairly well. But again, that doesn't mean everybody, but again, on average, it does. So as we think about implementing our plans, September, October is kind of when we should be developing that post-harvest plan, making that decision of, okay, how many bushels do I want to put in storage? How many do I just want to sell off the combine? And those kind of decisions. And really, it's that October, November period when we're in the heat of harvest that we're making those decisions. And if you look at that chart, December, October, November, what was prices doing? Prices were rallying. I mean, my gosh, it was looking great. And so if you kind of think about, well, has storage typically paid for me? Corn, grain sorghum, and soybeans, you'd say, man, okay, prices trending higher, I should store. Unfortunately, right, pretty much right after we made that decision, prices started heading south, and they really haven't slowed much. I mean, for the last 3 weeks, we've been kind of moving sideways, but I mean, we're really taking a hit. And so it's been pretty ugly. Now, so yeah, I did. So we'll just move on from there. This is a chart on soybeans for this year. Okay, so I did the same kind of analysis, not a 15-year average, but this is what I think is happening this year. November, prices were $13, according to NASS. Now, I've got question marks for December and January, and the reason for that is because the NASS data is kind of lagging. Here in the next couple, 3 days, we will find out what the NASS number for December was. So I'm kind of looking at futures and trying to make a relationship, but I think most people would agree prices have definitely trended lower. And if you still got beans in the bin, I think you're probably anywhere from $1 to $1.25 behind where we would have been if we just sold at $13 there at harvest. Corn, probably about 15 or 50 cents in the hole. Wheat, I don't even want to talk about it, but I've got charts just like this for both corn and wheat in the back of this presentation in my handout. Won't go through them, but none of these things have really worked out very well for us. So that kind of brings it, again, here's the assumptions that went into this. But this kind of then brings us back to our decisions, right? It's time now to make some decisions. If I've still got grain, whether it be oil seeds, soybeans, or corn in storage, or wheat even, I need to make that decision. Do I continue to store this physical commodity, or do I move it, right? And if I sell it, do I just say, okay, I'm done. I'm going to take my wounds and start focusing on 2024, or do I want to reown? And really the things that are going to play into this decision are your basis expectations. Where do we think basis is going to go? Historically, places I've looked as far as corn basis, milo basis, typically it's pretty flat, really from, Jan, Feb up through May. Now, we might see some strengthening in basis in the feed grains into the summer months. On the bean side, at least in eastern Kansas, typically the ones I've looked at here lately, typically seasonally, we'll kind of see some actual weakness. And so meaning cash prices might be weakening faster than futures. So the thing we need to be thinking, do I hang on to this stuff or not? Kind of reminds me of Dirty Harry a little bit, right? He always had that famous line, we got to ask that question. Do I feel lucky, right? Do I feel like we're going to see basis strengthen? Do I feel like we're going to see prices strengthen? Again, seasonally, basis is pretty flat on corn, feed grains, up through the next 90 days or so. Beans, I'd argue, typically might even see some weakness. I want to get done here after a bit. We'll turn this thing over to Dan. Hopefully, Dan will give us some insights on what he thinks we're going to see over the next 30 to say 90 days. What are our odds that we might see enough strength? Now, that table I've got there in the center of this slide are my estimated costs per month. Again, commercial, high interest costs, commercial storage, low interest costs, and on-farm, high and low interest. And you'll notice that I think on those on-farm numbers, they're fairly low than what they might have been before, because I'm kind of saying, hey, shrink, if it's in the bin, it's a sunk cost. So I'm not using that. I'm saying that we need to see wheat prices, for example, on that low interest. If I still got wheat in the bin, we need to increase between, from now into February. If prices increase even 3 cents, I'm breaking even, right? On the corn, $0.015, what, right? 0.014, so a penny, 0.4. Beans needs to be up there closer to 4 cents month-to-month increases just to keep my head afloat. So it doesn't take much if I've got it on farm, but we'll listen and tune into what Dan says he thinks prices might do. I'm going to turn my attention now and start looking up at the new crop side. And specifically, we're going to kind of focus on corn here for the rest of my things I want to talk about. Historically, 43% of Kansas is sold either before or at harvest. And so we're storing about 57% of the crop. Now, again, obviously, we've got some producers that's priced it all early or off the combine, and we've also got farmers in Kansas that store the whole crop. But when we look at the crop in aggregate, 43% historically is going to be sold before or after. So definitely, a preseason marketing plan is important. Pre-harvest marketing plan is important to put together. So regardless of what you're doing post-harvest, it's good. But also, there's some opportunities, right? You see that circles there. I've got May, June, part of early into July. Typically, we will see that December corn futures, right? This is a 15-year seasonal index of December corn futures. And that's what we want to use for hedging. We'll see prices well above at harvest, or even after that, post-harvest near-term rally that sometimes we see in futures. And so there's opportunities to price, and we need to have a plan. Something that Dan and I have always talked about and stressed is that when you develop that marketing plan, you need to have 3 key components, and that are pricing increments, you need to have pricing targets, and then we need to have pricing dates. Pricing increments is basically saying how much do we want to price each time, and that also then implies how many times do I want to price. I'm going to share with you here in a bit a very simple plan. So it's going to have few increments. But you know, everyone's got to decide. Also, on my increments, I always use a percentage of my APH, total APH production. Okay, total APH production. So I think that's a good number to go with. But you can use bushels, you can use percentages, but you need to find out what you're comfortable with. Pricing increments. Then we need to have pricing targets. And I put a dollar sign there because it needs to be, you know, something hard. And when I hear on the radio, December futures are here, or a cash price is this, I'm going to take action. Right? I need to have a pricing target. And then finally, we need to have pricing dates, which are designed essentially to compel us to action. Because, you know, I might have a pricing target of $8 corn. We may not see it this year. So if it doesn't happen, at what date am I going to take action anyway? Right? I want to take the emotion out. I want to have a price target, and I want to have a date that says I'll take action regardless, at least on a percentage of my crop. Other things that are very important. So important to know your costs, right? We need to know what our costs are. When we do workshops, Dan and I stress that very, very hard. I know Dan might even show some data on the earliest K-State projections here. We also suggest you learn about different marketing tools, right? By and large, everyone's very familiar with, say, forward cash contracts, but I think it's important also to kind of start using and thinking about how we might use futures or options. And then also, it's so important to create and work with a marketing team, whether that's your banker, whether that's your broker, whether that's your spouse and business partners. All those folks probably should be a part of your marketing team. All right, so how do we set pricing targets? What's a relevant target? Well, one way of looking at it is this. We look at December futures. I think it's a great index. I think it's a great thing to kind of just use because we're all aware of that when we're driving on the road. They're talking about on when they do the market report. And so what I did, just a quick thing here, we looked at the last 15 years, and we're comparing January 1 price. That's kind of our index. And then what happens after that? And I'm kind of looking at between then and September 30, because I consider that the pre-harvest phase, January 1 through September 30. And I said, how high? What was the highest price we ever got? And so, you know, you do that table, 2009, January, the first trading day in January, we were at $4.56. The highest daily close between then and September 30th in 2009 was $4.73. So 17 cents, not much higher than it was in January 2nd. And that was a 4% price change. The other spectrum down here, we've got 2023. Last year, we were at 607. The highest it got was 629, which is 22 cents. But you can kind of look in there, you know, changes. There's some pretty good years. And so I think that's kind of a, you know, we'll take a look at that. Now, on average, you know, harvest begins in Kansas about September, and we're 75% complete by October 30. So that's why I'm kind of using these. I do want to point out that I use that September 30 as my, you know, trying to look at what the highest price was. There were 2 years, 2010 and 2020, that really the contract high was actually later than that, right? It happened after September 30. So in 2010, for example, we saw a 77% or 77-cent increase, 17% price change, but prices after September 30 actually went higher. Same thing in 2020. We show that prices never got higher than January, but after September 30, prices did. Let's go ahead and rank these now, these years, and try to kind of quantify what maybe a relevant price target might be. And so, you know, 2012 was the best rally year we ever had, right? We were 590 January 1. Futures, December futures had a close at least once of of $8.39. So a $2.49 rally. And then what I try to do is break that thing out. So basically 27% of the time, 4 out of 15 years, we saw a better than $2 rally in prices, okay? 53% of the time, right? 8 years out of 15, we saw at least a 65% rally. And then 73% of the time, we saw at least a quarter. So I think those kind of give us targets, right? An aggressive target would be something up there, $2, right? Now, this January 1st, or the first trading day, we were at $4.98. So let's just say $5. And so, you know, to be aggressive, I might say, well, hey, I want $2.25 higher than that. So $7.25 might be an aggressive price target that I'll use. I'll go back here real quick. We've got that middle 7 years, right? 2017 to 2010, where we saw anywhere from a 77 cent to a 31 cent increase. Let's chart those out individually and just see what happened. Basically, these mid years, if you look at that, the black thicker line, is the average. Typically in a middle year, so we're seeing kind of just things kind of choppy, but maybe moving a little bit. They trend lower between here and pre-harvest. So I think it's very important that when we develop plans, when we develop pricing targets, we don't want to ignore that 50 to 75 cent rally, because that might be the best chance we get, right? That might be the best chance we get. There's a lot of years where prices just basically trended lower. But it also is important to see that, hey, May, June, July often will show a bit of an increase, and then those prices continue that lower trend. So what's a good sample pre-harvest plan? Well, here's a sample. I don't know if it's a good one, but I think it's a place to start as you start developing your own plan. Obviously, our objective is to buy crop insurance, right? We want to protect our production risk. We want to maximize the price received on any bushels sold before or at harvest. And again, typically, what is that? On corn, I think that's like 43%. We're going to be moving before or at harvest. So let's try to set some prices. And what I'm using here is, I got price 20% at 565, which is what? A 65-cent rally, right? We don't want to ignore. If I see prices jump up there, hey, let's get something on the books, right? Let's get something on the books and get that sold. But if not, right, that first line, number one, price 20% at 565 December futures or by June 1, right? Because a lot of times we'll see that rally up there into that June period. So let's, but if we don't, let's get something on the books. Now, let me see here. Okay. I've got pricing increments, 20%, 10%, 20%, and 25%. I've got pricing targets, $5.65, $6.25, $7, and $7.25. That's that aggressive price target, right? Because we want to be patient. I want to make sure we're going to see a good rally before I price a significant amount of my crop. So I want to be patient, but I don't want to ignore those 50 to 75 cent rallies. And so I want to have some aggressive price targets. And that's what I'm doing with that 7 and that 7.25. I've also got my pricing dates. You notice I've only got dates on 2 of them, right? The first and second. So what I'm getting at here is that if we don't hit $7, I'm not going to price any anyway, right? I'm just not going to do it. So what does this plan do for me? Well, this plan is basically designed to price at least 30% of my APH production, right, before harvest. But if we see a $2.25 rally, heck, we'll go clear up to $7.25 or 75% of my expected production, right? That's what this plan is trying to do. But at a minimum, we're going to be pricing 30%. Let's say now, haven't talked about pricing tools. Obviously, on these early ones, we typically would suggest you look at things more like cash based, something we're very comfortable with, something that doesn't have a lot of cost with it. So, you think forward cash contract, possibly a hedge to arrive contract, something, because at this point too, it's 20% of my APH production. Pretty good odds I'm going to produce that. I don't have much worry that, drought or something comes up, I'm not going to grow it. 10%, I'm waiting for a higher price, right? I'd probably stick with that maybe that cash based one. Again, maybe a forward cash contract. Hedge to arrive contracts. These other ones, the last 20%, the next 20%, the next 25%. At that point, okay, maybe we can continue to use forward cash contracts, but maybe at this point we may want to start moving over and looking at futures. Looking at some of these, options, maybe buying a put, using those instead, because maybe I don't have as much confidence that I'll be actually producing that large of a percent. So those are some of the tools you may want to consider. Again, it depends on what's in that marketing toolbox. Last thing on marketing plans, if you're using cash marketing alternatives like forward cash contract, never price at less than your expected cost of production. And that's why knowing what your cost of production is so important. Moving on to soybeans, I'm not going to spend much time on this. Very, very similar. I'm kind of a creature of habit. I've got a plan here that's basically designed to price 30% of my actual production history prior to harvest, right? But if we see a significant rally, right, $3 futures, right, $3, hey, we're going to go ahead and maybe do up to 75%. With that, that's a quick outline of those things. With that, I thank everyone for this opportunity, and I'll turn this thing over to Dan to kind of share his insights on what's happening with the market.
Mark, thank you very much. I really appreciate the thought you put into that, and especially, these things keep evolving and how we do it. I've note especially on the corn plan that you had that you're identifying that you're wanting to act with cash or forward contract oriented tools first, and then if we really get volatility that where things are hopping around, then you're probably looking more futures and or options based. So good stuff. Anyway, thank you for listening to us today. We'd like to talk about the futures, and we're just I guess I'm just very aware of the type of market that we're in, and what we can hopefully bring to you for helpfulness. I think our responsibility between Mark and I, we're in the mode of needing to give objective information as unbiased as possible. Now, I have opinions, and both of us do, and you'll hear them out as we go. But let's dive in on this. Weather is a big issue, and a good amount of what's affecting us right now in the market is better weather in South America, in parts of Brazil in particular, following very, very bad weather at the start of their soybean crop in Mato Grosso, Parana, some other places, and that also has had an impact on the corn crop. It's been very difficult to sort out just what's happening, and I guess we're at the mode where we ask the question, well, did the damage that was done to those crops early on, is that offset now by more moisture, cooler weather later? I think that'll be the major driver of the market direction going forward, and the market's pretty obviously paying attention to USDA numbers. There have been much more pessimistic in-country numbers that have come out almost uniformly than the USDA numbers. But in the January 12th report, the USDA did make the first steps of adjusting down both the corn and the soybean crop in Brazil. But so it's the direction is set, just a matter of where the landing is. And the markets have seen prime example last summer, where we had great fear and trepidation that we'd have a very, very poor set of corn and soybean crops, and the U.S. Central and Eastern Corn Belt ended up with decent moisture, and now we have a record yield of 15.3 billion bushel of corn. So our recent history has probably affecting the response of the markets to what we're seeing right now. So given that we're given so much attention to weather, you can note here that the kind of a most recent short-term projection of moisture, kind of I guess a composite forecast. You can see a fair amount of moisture in parts of Kansas, southern Kansas in particular, parts of the east of Iowa, not looking too bad. The three I states, the southern part of Illinois, Indiana in particular, not looking so good. So that in the short run, there's been some moisture. Minnesota's caught some. The longer term, we still have long-term indications of drier subsoil. This summer, the markets aren't focusing on this at all. We've had Chip Redman at K-State, other respected climatologists talk about the La Nina to El Nino and back potentially to La Nina pattern that has a greater than 50% chance of happening, given what we know right now, and that would bring about some risk of dry weather. But that's not right now, the markets are doing what markets do. They're assuming normal weather all the way forward. My contention would be that we have weather risk to deal with yet in this year. It may not, probably not going to show up until we start trying to put crops in the ground and going forward. But you all as market watchers can read the same headlines that I do, and that I guess in trying to be as objective as possible, we are not settled that we're going to have an outstanding crop yet in 2024 for corn or soybeans or any of these other crops here in the U.S. So that weather uncertainty in itself will play into the seasonality of prices, and is what we need to consider with regard to any old crop storage or new crop pricing opportunities that come forward. So here you see these maps. You can see the areas that we're watching. There's the South America, central northern parts of Brazil having real dry conditions, a lot of moisture in most of Argentina, and some of what's holding back crop prices is that projection of strong recovery in Argentine corn and soybeans. So we'll see there. No problems in the Black Sea region to speak of. I in my own private thoughts, as long as the Black Sea region avoids drought and keeps pumping out crops in quantity and onto the world market, it's hard to see us having a lot of traction in the wheat market, especially. They're just such strong competition, poor currencies, low prices, almost fire sale for Ukraine in particular, and it's just tough for us to compete against. No major problems, no major droughts. If anything, probably too much moisture in parts of China and India. So nothing to really drive us in the markets there. Although at times you'll see China come in and with quality issues or whatever come into the markets pretty strong. So it's really hard to read those folks. And in fact, one of the issues that makes us wonder about the La Nina to El Nino back to La Nina situation is that this El Nino cycle episode in Australia hasn't been as critical, as dire as past ones. So you bring that together with both El Nino, La Nina patterns, and I heard a North Dakota climatologist talk about how the ENSO oscillation is certainly important, but it's not the only weather effect in that affects the globe. So we've got a lot of questions to answer. I think right now the markets are not having to deal with these yet, and we'll see if they become an issue as we go forward. Feed grain markets, without question, the reality of current situation. You're back in mid-late October up to five. We were had a high up to 521. We're hanging around $5 and have eroded all that much more here. We got into January and had the January 12th report come in with the 15.3 plus billion bushel corn crop, and only moderate adjustments in South American production to the lower side. And we find ourselves at the situation that we're in, having got down to about 436, 437, kind of bouncing along sideways now, and wondering where the market might go. You look at the futures, it's interesting. You just remember this chart for corn, and whereas we're about 446, so we were on Friday, or a little lower than that today, it looks like, on the futures, but we have positive carry all the way out into December, and it seems to be indicative of production risk and worry. It would mark for new crop bids, even though these aren't at the level people would want. Still, it's indicative of something to watch, and probably way in the background of all that thought is the idea that prices generally, new crop prices may favor soybeans more, and we'd see more soybean acres and less corn acres in 2024. When you see the soybean chart to match this, you'll see that we get up to summer highs, July, August, and then we decline into November. And some aspect of the carrying charges from where we're at now, where we're at here from the March contract into May. So 4.7 cents, et cetera, per month. So that's worthwhile. But note, from the December closed, figuring where that 446 is at, we're down, Mark, just like your chart had said, about 3.5 cents a bushel a month. You add that together, that's 9 or 10. So right now, if there is an opportunity for storage, it seems to be a ways out there. Did want to bring this up in our current pessimism in the markets. You stand back from a longer term view and look at where prices, and if you can see my cursor, I've got this a range of where market prices have tended to trade when we haven't had a drought or a major shortfall or a financial issues coming into play. COVID-19, trade wars with China, you name it, all coming into play. But when we're not dealing with higher prices, we've tended to be in this range of about $3 to about $4.75. And note that now we're getting down low enough to where probably in our recent memory, again 2014 through about 2020, 21, early 21, it was where we were hanging out. Well, now we're low enough to where we're back down in, we're touching down into that area. And, that's thought provoking, and surely brings up questions of is this where we're going to go? Good question. I think potentially that's where you go if you have good crop upon good crop upon good crop and really build up ending stocks. Cash prices, it's noteworthy even at these low areas that we have the stronger areas. Really, at this point, it's no surprise that Garden City has the highest cash price in the state, and the new crop bid of at 20 over, and harvest forward contract 10 over. But Hutchinson been pretty strong almost most of the winter relative to other locations in the state. So some spotty crop problems in the Hutchinson area, ethanol plants, you name it, all affecting that. And for grain sorghum, there's one quiet star, I guess, right now in our commodities in terms of exports, and it's grain sorghum. And you can see it in the export oriented areas, particularly Salina and Hutchinson. Hutchinson highest price. We've got some pretty good bids, 50 over, 40 over. And this is one of those occurrences where the grain sorghum exports can stand out alone. It's almost all of it, literally almost all of it's going to China. They have a beverage that they make there, and it fits for them. And we have strong run, and generally a poorer crop in Australia, even though the El Nino isn't as bad as we thought, but still a poorer sorghum crop, main competitor. So they're coming to the U.S. for the main supplier, and it's noteworthy though that the cash bids are different. But when you look at the forward contract bids, you still are seeing lower forward contract bids for sorghum than for corn. So the market must be voting with its feet that they think this is a shorter term phenomena. And one way that I try to understand what the markets are thinking is to look at the speculators, or what we call it managed money traders, their long versus short positions. And note here of late how, on the red, the red below the zero line bars are showing millions of bushels sold short. So speculative traders selling short. The blue spec traders buying long. So if they sell short, they're planning on making money on the market going down. Well, you know, you look at this critter, and as the futures have come down, this sell short position has grown quite a bit to where it now it's, you know, it's touching over basically over 2 billion bushels, and is comparable to about as low as it's gotten when you get back into 2018, 2020, etc. And in those times, you're getting back into markets in that low price time frame. So we've got a major epidemic, major bearishness in the market right now. There's I don't know exactly what this I guess the best way to say this is these things don't always hang around for that long. And you can go, there's probably a story for every one of these selling episodes, and there's a seasonality to it. But as it is, we've been strongly, if anything, more consistently, other than maybe back here in 2012, 13, more consistently driving ourselves to these short sell negative positions. And I guess it's January. We'll see if they hold around with the weather risk that we'll have to deal with and uncertainty out into March, April, and May.
Hey, Dan.
Yeah.
On that previous chart, one of the comments you made there was that, and again, I sure see it. You go back in history, when we get this level of shortness, excuse me, it doesn't last that long. Now, again, the long run trend could go, but I guess, you know, does this suggest that, okay, you know, especially if I've got like corn that I need to move, but it's on farm, my costs are sunk, I'm not really accumulating that much, especially on the corn side, as far as, you know, storage costs. Is this kind of telling us that, you know, there's some chance here that we could really see the specs kind of jump in here and could see some of these futures, you know, say May contract, even the March contract, kind of do a quick bump up and maybe give me an opportunity to move that stuff. Or if I was going to buy a futures or, you know, buy a call or something, it might give me an opportunity to make some of those kind of things work on my post-harvest market.
Well, yes, and you know, so you have traders that have sell positions. If they're going to make money on, if they're going to take the money out, they're going to have to sell back. They're going to have to buy it back. So that at any time, calendar wise, would be of help. And you know, so they have a lot of these positions in the March contract. They can carry them, and they'll want to get out of the March contract before well, sometime at the latter half of February. So that's, you know, that's just the normal way, financial way that traders function. So be watchful of that. And that's without any other information entering the market. That would be just profit taking, I think we'd call it. Does that sound right, Mark?
Yeah, I think so. So again, you know, depending on what my costs are, right? As I'm trying to make these post-harvest decisions, do I dump the commodity, or do I buy a call? Do I do something? Maybe we've beaten this thing down enough that, you know, maybe, I mean, it's not a recommendation, but maybe something to consider would be hanging on a little longer, or buying a call, or some of these things that we might have some harvest opportunity.
We pride ourselves in being objective, research based, but like I say, we're trying to understand the psychology and the timing of the handling of these positions, and when risk is going to come into the market. And if there is risk from these other sources we've talked about, South America, it's not come home to roost yet. So we have unabated bearishness, and it ends up with a situation like this. Let's go on. I think I just would be aware of seasonality in these markets. We're coming into January, February, and quite often February is just death valley for any volatility and movement in the markets. You're just hoping to get to the end of it before we get into field work and other things come in. Well, you know, given what we have right now, you can see we have tended over time, in looking at the marketing year months, September to November, and then the percent of the season average prices, we've tended to come out of harvest. In the past, we come out of harvest lows, come into January, February, March, and then saw our higher prices off into April, May, June, and with the potential for some strong upward volatility. Once we get into spring planting and we start to see how the crop is looking, etc. Mark, our whole winning the game workshop, I think, is based on this, trying to deal with this uncertainty. But we're right now in the short run, and we're just coming to a choke point. Historically, January, February especially, if you're holding on to old crop grain, then that's something to look at. Add this in also. So take that same January, February, kind of different color scheme for the seasonal price index, high lows, etc. The futures, if you see how the futures are lined up with their little bit of carry, they're not really. They're representing a drop off from decent to January, February, but they're showing some gain up into the spring, but they're not showing normal percentage seasonality. And you could argue, well, they've already come down to the low side and they're showing some going on the high, whatever. But at a minimum, even if this was the new average, and you get out into May, June, where all that volatility can come, we're just not representing anything like that right now. It's not on our minds. So I'm not saying this is the golden answer, but I'm saying that history shows us, just the data shows us, there's a lot of potential for volatility. Yet that'll have to be dealt with before we can get out into the fall of 2024 and say, hey, we've got a second consecutive large crop, and we're going to have pretty low prices. And so, in the interest of time here, I just want to save there. If you look at U.S. corn acres, there was a quick survey done by Farm Futures. It was of farmers, a farmer survey. Came back and stated that they anticipated just under 93 million acres of corn, 92.8 to be exact, and that would be a little bit lower. We'll see. For this year, again, it's farmer survey online and you can stand back and take shots at those types of surveys all day long and have very justifiable criticisms, but yet. That's the first set of numbers out. Doug Bounds is online from USDA NASS, and I think that the first actual survey done by NASS, the first credible, widespread one, will come at the end of, it'll be reported at the end of March 30th, last business day of March by USDA NASS. So until then, we'll be looking at surveys like this to try to figure out what farmers are actually saying. So, in the interest of time here, I want to just show you corn exports doing okay. You can see all the trends by week and millions of bushels in our rate analysis as we go forward. So corn exports, not wonderful, not terrible, just about in the middle. Grain sorghum exports, you line up most of these years, and grain sorghum exports have been doing pretty good. And hence those good basis bids we saw earlier. You could see almost the week when China entered the market, started to buy. So good for grain sorghum, I guess would be my thought. I would just state that the market sees this 2.2 billion bushel corn crop, ending stocks, and that's its basis for bearishness. And it all it took was from 1.36 to 2.1, and we're not worrying. So there you go. That's the psychology of the market at the moment. And also with that, you're seeing again a jump in ending stocks, 14.8% stocks to use. Pardon me. Price projected lower at 480, and we'll see where all this goes yet this year. And this is for old crop. We don't have new crop 2020. I haven't put out 24, 25 numbers yet, but the USDA Ag Outlook conference coming up in the latter part of February, and those numbers will start to come out then. I do want to show just quickly here. So this is what the USDA says. For this year, and let's give them their due. 60% probability, 50% plus. they're likely right, but there are places where this can fall apart. 60%, there's that 15.3 billion, 34 billion bushel corn crop, 2.162 ending stocks, 14.8% stocks to use, 480, 475 price. And in my thinking, we're not accounting for how low prices tend to increase usage, and so here you look at higher ethanol usage, higher exports, or a combination of the two coming in. Well, in so many words, when you have this higher export scenario, in my thinking, you're pretty much looking at shorter crop coming out of South America, the need for the world to come to the U.S., start buying some more corn, that increasing our usage, shortening up our stocks, ethanol and exports both together, a more serious situation down South America. And so after all that hand waving, pardon me. So given that we've got fairly large surprise, eventually you get below supplies, you get below 2 billion bushels, stocks to use declines from about 15 down to about 13.4, and we gain about 60 cents. So we'd have to have a catastrophic. I don't know that the big run-ups are going to happen until you get out in the summer of 2024 and start to have a threat to the 2024 corn crop. Okay, let's move on. Take a quick look at soybeans and some of the same things. We'll move pretty quickly here on this, and again, you all have that PowerPoint to look at the details. Otherwise, drop basically $2 in the soybean market. This was a year paid to have sold soybeans at harvest on the run up, but because as we dropped off, as we've certainly seen the negative consequence of that. I do want to show you here again for soybeans. We do see from 1209 Friday's close a little bit of positive carry in the market, but then a drop off, about not a lot, but less optimism about higher soybean prices this fall than relatively higher corn prices. Note the same chart for soybeans have generally held up a little bit higher than the top end of the lower end price range of when we're not dealing with droughts and geopolitics and you name it. 1202.5, we're generally haven't dropped down into that lower range yet. Cash
Dan,
prices.
Quick, I'm going to break in. We had a question about how the U.S. dollar will affect exports, and then Doug also noted that the prospective plannings report will publish March 28th. But the question was, how will the U.S. dollar affect exports?
Well, it hurts it. A lower U.S. dollar hurts any U.S. exports against Brazil. In particular for corn and for soybeans, and given that there are a whole bunch of other players, a handful of other players also, for wheat, it probably hurts us the most in wheat. And
did you mean to say lower U.S. dollar, or did you mean higher U.S. dollar hurts it?
Thank you. Yep. Thank you, Rich. Yep. A higher U.S. dollar, which makes it more difficult for U.S. priced cash wheat to be competitive. Yes, thanks, Rich. It puts us in a competitive disadvantage. That, and if our colleague Guy Allen were here, that plus the higher shipping rates that have come about from the Red Sea issues and that are happening. All that works against us in all of our exports, but it hits them and hurts the most in wheat, just because there's so much more competition and the world has other places to go besides us. So good question.
Thanks.
So note for soybeans, there in Hutch, you have the highest price, just under 12 cash wise. Topeka, not far behind it, 11.74. What I would note here in my thinking is that kind of looking at spot prices rather than futures, and look at that very bottom line: new crop soybean versus corn forward contracts. And if you go with the idea that 2.3 is about a neutral situation, that in all these areas of the state except Garden City with the feedlots and the ethanol plants, we have a ratio, a forward contract soybean to corn bid price ratio that would favor soybean acres. Some less out in the west. Note that 2.4 in Colby, along with the 2.26 in Garden City, but you're closer to 2.4, 4.5, 2.5, 2.6 everywhere in the eastern 2/3 of the state, and at these locations anyway. So we'll see. We'll see where all that goes. Here's the same chart for soybeans. That on the one hand, it's noteworthy that, relatively speaking, there are still more optimistic longs, although they're declining, and the bears have in recent times have, if they were bidding around in here before, they've at least doubled in the short run their negative position. But they're not, and they're down, they're getting down into the areas of 17, 18, 19, pretty pessimistic for prices, $8 soybeans, the most pessimistic summer of 2019. So we're diving off, and if we're seeing weakness right now in the short run in the soybean market, I think this is just a symptom of it. Note again, so what typically happens long term in the soybean market, January, February, we have tended to have a fairly close range, a little bit of increase. That's from the last 23 years. I think that market's changing a little bit as South America has emerged. So some of our run up is not quite as strong as it was. But note now, from 2016 on, last 7 marketing years, our choke point becomes February, March. We're starting to get new supplies out of South America. We still have a run up based on U.S. crop production uncertainty, I think, primarily out here in May, June, but the emergence of South America has affected our seasonality of prices. Note the futures, again, come down from November, D's, etc., and they are basically sideways. So and I hope this is not just cheerleading, I hope it's objective. It seems like the futures are not accounting for any production uncertainty in the United States. They're not. They're going sideways right through the time frame when we would typically see questions about our acreage, about our seeding, about anything related to that crop all coming into play. I think of that, and I think of what the climatologists are talking about with regard to La Nina, El Nino, La Nina again. And if there are things that are going to affect the market, it's out in front of us, and we're not really paying attention to it right now. And note that farm future survey for beans projected just about 85 million. So a few more, or about 1.5 million more soybean acres, about 1.5 million less corn acres. And again, Doug being on here, the market was affected by, first, last year, what we had for the corn acreage numbers at the end of March. But then at the end of June, when we saw what farmers actually did, affected by a whole bunch of factors, we dropped corn acres 2 million acres. We dropped soybean acres about 4. We increased corn about 2, and find ourselves just about here at this where we're at right now. So very uncertain. I don't know that we can have a rest easy on any of these numbers, but as always, farmers will vote with their planters. Just want to say quickly, we're you see domestic crush the last 4 marketing years, last 3 and one we're in, following this steady increase, moving to the higher side. You see exports, U.S. soybean exports declining. Also those during that same time frame. So when we're wondering about the impact of renewable fuels, bioenergy development on the oilseed side, and what's it doing? How's it affecting us? Here you have it. We're in the process of shifting over our soybean usage to the energy sector and away from parts of it anyway, and away from the export side. So it is as it is. Soybean exports doing decently. Again, not just probably a little below the rate that you would see if we were on average. And note we've generally been looking at a little bit lower but slightly increasing stocks to use in the U.S. And with that, prices having run up here, strong prices from when we got to $13 and $14 before, we were at 4.5 to about 3% stocks to use. We got to 5, etc. 5.7, and you can see what happened to prices. Well, we've been at this 5.7 to 6, have run up, and now starting to increase a little bit, and have seen prices come off. So it's a supply demand response. And here would be my thought. Again, similar situation. Soybeans, what the USDA says, say 60% chance that they put their numbers out. They're judicious in what they've done. Good. But where could they go wrong? Well, the Brazil situation, and it just to varying degrees. If you have medium Brazilian problems, serious Brazilian problems, really serious Brazilian problems, you get back down to, you start getting below to 5.5 to 4 to about 3.5, 3.6% stocks to use. And yes, you're seeing this K-State guy coming here and talk about $14 to $15 soybeans. Well, that's if the Brazilian fears really come into play. Say a 20% chance that happened, but the fear of that is out there. Futures right now on average projecting about 1230, 1240 thereabouts. And again, if this occurs, it's not really on the books. Okay. So let's finish up here with wheat. I know we're at 1. We'll be judicious. So here you got an amazingly similar commodity price trend in another ag market that's important to us here in Kansas. And you see the wheat after summer, July high and 927. You can see where we're down now, have gotten as low as about 595, 586, 587, 624 on and 3/4 on Friday's close. A little bit of carry in the market. For old crop, not much. Sideways, a little bit lower into harvest, essentially sideways. But then heading beyond that, again, relatively speaking, about 20, 30 cents moving to moving upward. And where are we at on wheat? The situation we've been trying, at least in my thinking, trying to figure out how's wheat doing relative stead, worse than corn and soybeans. Hard red winter, more not that far above 550 middle ground of a lower end price range of this lower end price range that we've got. So rougher times for hard red winter wheat. And the export question that was asked earlier is dead on in terms of probably the primary issue for hard red winter wheat as to that is leading us to this deal. Cash prices, highest cash prices in the export oriented areas, Salina, Topeka, Hutchinson, and sometimes folks have asked, well, if corn prices were holding up decently and wheat was falling off, we'd say, well, what about wheat feeding? If you look at current and new crop wheat feeding, about around 1.2 1.22 for spot prices, new crop 118. And generally I've been told about 105%, 106% or 1.05, 1.06 would be about where you'd have to get to start bringing wheat into a lot of these rations in a strong way. And wheat prices have done their part, unfortunately, but right along with it, so is corn. Taking a look here at hard red futures, pretty bearish also again. Not the absolute worst. We've had worse in 18, 19, but pretty strong negativity. Actually pretty level long specs, but the short specs are twice the volume as the long specs. There you go. And January, February, with our current situation, you can see our typical seasonality really pretty flat. A little bit of run up February in most years, that's from 06 on. But gracious, futures are reflecting the pessimism that they're fed really from the poor export performance. Wheat acres, the winter wheat overall projected to be down about 6% by USDA NASS in the winter wheat and canola seedings report. The Farm Futures Survey was surprisingly more optimistic than this thing, about 37 million acres, but the 34 thereabouts, that's the USDA number right there. The farmers were more optimistic than the USDA numbers were showing. So just want to show this so for all US wheat, you can see our tracking by week and millions of bushels, and compared it to other years, we're hanging along the low side. And this is what's just really, really damaging us for hard red. You can see that our track is way below anything we've seen since at least 2015. Just really, really hurt. Other wheat classes, hard red spring, not doing great, but a little bit better. Soft red had a early run and has been bouncing around some, generally doing a little bit better, but not record. White wheat, about the same as spring, not the worst, not the best, but you know, I don't want to bemoan the fact of what we've got, but for hard red, our exports are the weak leg. The milling use going pretty decently. And so again, you can see these are pretty familiar. 35% stocks to use, price projected at 720. And if anything, I see that hard red number and the general weakness of exports. And whereas I was pretty much showing higher price scenarios for the other commodities, we're still at risk until this dollar issue gets unwind, or there's a drought in the Black Sea region of weakening even more for wheat. And so these scenarios here, the USA is projecting 648 million bushels carry out, 34.5% stocks to use, and I'm just showing weakening of exports, higher stocks, and prices weakening potentially more. It's only like 5%, so you're out here looking at 15% as a probability for the worst scenarios. But Mark, that's at least my thought. Okay, so I would say this. Okay, so we're down on wheat, but yet you have this. So the market is the market is myopic. It's looking at what it's got right in front of us. Yet you've got this deal going on, pardon me, where you have world wheat stocks to use, and world wheat minus China stocks, which for wheat is more accurate, lowest it's been since back in 2007, 2008. So my own thought with the driving time around the state is that, we're as long as we keep having these cheap supplies and myopically, if the world's not coming to our doorsteps to buy wheat, then then we can just keep hammering wheat prices. Someday, I think out there somewhere, I'm not projecting this year, whatever, somewhere out there, the world will have to deal with that. It'll get very likely to get caught short, and we'll have a pretty volatile, explosive wheat market to the high side. But and it's being and we're setting ourselves up with from 17 to 23, just, we were at 25-26% stocks to use now, or that lowest since back in there, and that was a volatile, that was that big run up we had in 7-8 for the markets. So here we go. We're setting someday out there, the market will be surprised. It won't have this hand to mouth situation that's going on, and we'll have to volatilely jump to extreme highs to try to encourage people to grow wheat, but it's not here yet.